What's up guys, my name is Nick and welcome to my channel. In this video I'm going to take a look at the poor man's covered call. This is another excellent strategy that is also suitable for smaller accounts. I'm going to dive straight in, so if you're unfamiliar with the basics of the covered call strategy, you should check out a video I've already made covering any relevant concepts. I'll include a link for you somewhere up here. If you enjoy the video and find the content useful, don't forget to smash the like button, subscribe to the channel, it helps me out a ton. See you guys on the other side. A covered call refers to a financial transaction in which an investor selling call options owns an equivalent amount of the underlying stock or security. This means that for every 100 shares you own, you'd sell or write a single call option to create a covered call position. The short call generates additional income and provides some downside protection should the stock price fall. A poor man's covered call is a very similar position in which the long stock is replaced by a long-term deep in the money call option. Because of the very large delta, typically close to 90 or 95%, this call option will closely track the price of the stock itself. The reason the position is referred to as poor man's covered call is because the buying power or cash required to buy the call option is significantly less than that required to buy the outright long stock. Let's compare three positions and look at the performance of holding outright long stock, a traditional covered call, and the poor man's covered call where the stock is replaced by a long call option. Okay, so let's construct a position in SPY, the S&P 500 ETF tracker. The reason I've selected this ticker is the options market are extremely liquid in this underlying, which is important. The further out in time we go, the less liquidity we tend to find. So while liquidity might be good up to say 30 or 40 days, once you get beyond 3 months or so, we do generally find the markets get wider and are much less actively traded. At the time of making this video, SPY is trading at 354.04. So in our specific example, for the long stock position, we'll be considering 100 shares of SPY stock purchased at the current price of $354.04. The covered call for comparison will be long shares at the same price, of course, but also a short $365 call option that will be sold or written for $4.30. Given the option multiplier is 100, this is equivalent to receiving a credit of $430. This call option has just over a month or 38 days until expiration and is currently trading with a delta close to 30%. Since the delta is the approximate probability of the option expiring in the money, we should expect that around 70% of the time that this call option will expire out of the money and therefore worthless, with the stock trading below 365 by the expiration date. The poor man's covered call includes the same short call, but rather than the long stock, we are long 1-2-55 strike call, which as you can see is deep in the money and has a delta of approximately 95%. The cost of the option is $100, and we can see that nearly all of the value in this premium, or approximately $99, is intrinsic value. The extrinsic or time value component then is just a little under $1. This is how much the call will decay by the expiration date as a result of the passage of time over the 101 days that currently remain until its expiration. First of all, let's take a look at the buying power requirement, or how much money we need in order to place each trade with your broker. The long stock first. This is simply the purchase price of the stock multiplied by the number of shares, or 35,404. The traditional covered call also involves purchasing the 100 shares, but part of this cost is offset by the $430 premium you receive for selling the call option. Our buying power requirement then is the difference between the two, or $34,974. Finally, the poor man's covered call does not require the cash needed to cover the stock purchase, but instead just $10,000 for the purchase of the long call. Note that the longer the expiration you select for the long option, the slower will be the rate of the theta decay associated with the long call option. The downside to this, of course, is that longer dated options will have larger premiums, and this increases the initial cost of the trade. If we calculate the total net premium paid by taking the difference between the $10,000 debit paid for the long call and the $430 credit received from selling the short option, we can see our buying power is around 3 to 4 times less than both the long stock and the covered call. But let's see how each strategy performs though, depending on where the stock is trading in 38 days time when the short call expires. Firstly, let's assume we expire right on the short call option strike and that SPY is trading bang on $365 a share. The return on the long stock holding then is simply the difference between our purchase price and the current price that the shares are trading multiplied by the number of shares we hold, or $1,096. The covered call not only makes this amount from the rally in the stock price, but additionally, since the call option expires worthless, we collect an additional $430 in premium. This is equal to $1,526 in total. The calculation of the return of the poor man's covered call is a little more complicated. Like all calendar and diagonal spreads, the value of the position at expiration of the shorter dated option is not certain and depends not only on the price of the stock, but also any changes in the level of implied volatility and the rate of decay of the long option. Since the option has a 95 delta, and for simplicity we'll assume this is held constant, we should see that the change in the price of the option due to the rally in the stock price should be approximately 95% of that change in the outright stock price. Due to the passage of the 38 days since the long call was purchased and an assumption of constant daily dollar theta decay of $2 per option, approximately $76 will be lost as time value. Note the overall package is net positive theta since the short call option decays at a significantly faster rate due to the shorter time to expiration. Putting all this together then, and also including the premium received from the short $365 call, the total profit then is approximately $1,395.20. So, in this scenario then, which notably is the best case for both the covered call and the poor man's covered call, both strategies outperform the long stock, and in the case of the poor man's covered call, with significantly less capital at work. Specifically, the annualized returns on capital at this price level for each strategy are 29.7%, 41.9% and 140.03% respectively. You'll notice that as we now trade above the short call strike, in my example here I've chosen 375 as a level, so the long stock position begins to outperform. The increase in probability of success of the trade due to the sale of the short call comes at the cost of any additional upside gains in the trade above the short call strike. So specifically, each strategy returns $2,096, $1,526 and $1,345.20 if the stock ends up at 375 by the expiration date. Let's now take a look when things don't go so well and the stock price actually goes down in price. At $345 a share, the stock position loses $904 in total and performs the worst of the three strategies. This is due to the additional premium we received from the short call in both the other positions. At this level, the call expires out of the money and worthless, and so partially offsets the losses in the underlying stock in the covered call position and the long option in the poor man's covered call. Note that the short call only provides partial protection though. And as the stock continues to fall, let's say to 335, each strategy loses money at roughly the same rate. So the main takeaways are then that both covered calls, whether the traditional or the poor man's, the strategy has a higher probability of profit, but at the expense of capped and limited upside potential returns. By selecting an appropriate strike for the short call option, you can adjust the premium you receive from the option sale and the probability the stock trades above the strike. A higher strike, for example, would be more bullish but generate less premium income. Additionally, the poor man's covered call is significantly more capital efficient than either other strategy due to the replacement of the stock with a long-dated, deep-in-the-money option. This makes it a popular vehicle for smaller accounts looking for a bullish, long-term income-generating strategy. Guys, if you made it this far, you made it to the end, and I'm incredibly grateful for your support. Again, if you enjoy the content, you can subscribe to the channel down here or watch any additional relevant content by clicking over there. Until the next one, take it easy. Cheers.